like we did last year. We're emailing out the increment report forms, the county-specific increment report forms, and the generic Excel calculators, and the livestock information that I got from David and other price stuff. That's being emailed out. It'll probably take a few days. We're sending it to the county email offices, and we're sending it to the A&R agent offices, and probably the IPM agent offices. So hopefully one way or the other, you should get that email. But if you're hearing this recording next week and you didn't get an email from me, then let me know. All right, on to the market. So cotton market, if you look at the right-hand side of that chart there, since August, we've been bouncing around in the low 70s to just at or under 70 cents. I can explain that with this next chart. What caused the great big decline, that big fall right there from 85 cents downward, I would attribute to speculative selling in the form of this last historically large green spike of selling. That's speculators going short to make a profit with the expectation that the market was headed down, and it's sort of a self-fulfilling prophecy. All right, so they got to their maximum way down here about a month ago, and then they bought some of those positions back, and that's why we've had a little bit of price support. We bottomed, we had an uptick, we're bouncing around 70, 71 cents. The reason that we're bouncing around and not declining anymore is because this right here represents a buyback, and there may be more of it to come. I'm kind of surprised actually the prices haven't risen more than they have, given this amount of buying, but that's where we are. Fundamentally, we continue to have a balance sheet. These are USDA numbers. The last column is what's published last Friday by USDA, and it represents basically kind of a modestly bearish outcome of, down here at the bottom, 4.3 million bales of ending stocks, which is more than the year before. So we would expect to have weaker prices because ending stocks is higher than it was last year. And actually, even comparing it to the October estimate of this same number, it was 4.1, and now it went up to 4.3. So again, in the short run, in the year-over-year comparison, either way, we're having growing ending stocks, and that suggests weaker prices. They trimmed the production number just slightly, but I think as far as the size of the 24 crop goes, we're kind of zeroing in on that number. You know, they may cut 100,000 here, or then they may add 100,000 in the next few months, but I think we're zeroing in on that number pretty much. And demand, exports, we've had a few decent export sales reports in the last few weeks, but demand generally continues to be characterized as slow. So I'll just shift gears and look ahead to next year. I think we're going to plant a similar level of planted acreage. The forecast for weather over the winter is drier because of a mild, short-lived La Nina situation. So I think that's going to lead us to pencil out basically a similar situation for ending stocks, and the way I'm penciling it, nothing particularly rosy as far as a price outlook. Here's how I would base my acreage prediction. Just looking at the ratio of new crop corn to new crop cotton, that ratio historically would put us in a historical realm of planting that's really around 12 million, but I can't see us going up that high. So I would probably go with about 11.5 million or so. And if we plant 11.5, that may still change, because historically, seasonally, we tend to have price rallies over Christmas. This is the average December futures, like 25 years of December futures prices in the month of December preceding the year that they expire. Usually in the first half of the year, prices will climb to their mid-year highs. But there's typically rallies that happen here, which is good because this is when our insurance price is getting established. We need rallies to happen here. So if we're at 73 or 72 and a half this morning, I wouldn't be surprised if in a month or two we were at 75 or 76. I wouldn't be surprised come June if we were at 79 or 81 or something like that, if it follows the regular pattern. Again, this is just a prediction of passing mild La Nina impacts, which generally for us mean drier winters. So putting all that together in a balance sheet, again, if we plant 11 and a half and we have 17% abandonment and we have an average 800-pound yield, that'll give us something just under 16 million bales of production. And if we produce that much with the kind of the demand situation that we're continuing to be in, here's the ending stocks number. It's higher than what we would see for the 24 crop. It could be over 5 million bales. And if that was to happen, that would not be price supportive. That would probably seasonally take us from whatever the highs are, upper 70s, low 80s. It would take us back to 70 or maybe even a little under 70 if it looks like we're going to wind up with over 5 million bales of ending stocks. And the last thing I'm going to say is we've had an election. The stated goal or policy intentions of the incoming Trump administration is for tariffs. And I would just remind folks that the last time we had tariffs imposed on non-agricultural imported commodities, our trading partners responded with tariffs on our agricultural imports into their country, and that hurt the cotton market. So I hope it doesn't happen. I hope it doesn't happen. And that's it. So I will end my slideshow and hand it back off.
Great. Thank you, John. And any questions for John? Mark, do you want to start your presentation?
All right. Let's see if we can figure this thing out. Yeah, good to be with you here this morning. Hope we'll get the slideshow up and going. Do that from the beginning. And if we're looking okay, we'll go ahead and get started.
Yes.
Again, just looking at maybe some updates we had from last month and some concerns around wrapping up this 24 crop year. Particularly, we're looking at corn harvest finishing up in the Midwest and the price impact that has, of course, across the country. And then just as John was sharing in the cotton market, share maybe how things are looking right now as we look ahead to 2025 and perhaps are starting to put some marketing plans together. The major theme of the 24 crop year, whether we're talking about wheat or corn or soybeans or grain sorghum, it's one of tight margins. And that's if you made a crop, looking at high input costs, declining prices. And then our overall fundamentals, as you look at the balance sheet that we'll look at here in just a moment from USDA, is that overall, and we're going to focus on the corn market this morning, that the factors of supply in this current marketing year have been increasing faster than the factors of demand. And that's not positive for prices, and that's exactly what the price response has been. And then we'll look ahead at perhaps what 2025 might look like if that looks any different for our grain markets. This year's been characterized by very favorable corn crop condition ratings, particularly in the heart of the growing season. This would be the share of crop rated in the very poor all the way up to the excellent categories. If you combine those good and excellent ratings, we didn't drop below that 65 or so percent, 2/3 of the crop the entire year. And that's very favorable. If you look at the condition index that create on these shares and these different ratings, the average index would be that blue dotted line. And then the current year index, the black solid line, has pretty well run above the average or normal levels for the entire growing season, and then wrapping up the year at about what you would expect a normal kind of rating would be. Now, to zoom in on that a little more closely and compare this year's crop condition ratings to last year and to average, this is what that looks like. Again, this is the crop condition index. The average index would be that red line, and a trend line yield giving average conditions would suggest a yield of about 181 bushels per acre. In 2023, we kind of struggled to stay close to that average index, kind of ran below that the entire year, still set a record corn yield last year at 177.3 bushels per acre, and then ran at about 1% below what that trend line expectation would have been. In 2024, again, right in the heart of the growing season, we had better condition ratings than normal, and USDA has updated their yield in the November WASDE and the crop production report. Actually lowered it just a little bit, 183.8 bushels per acre in the October numbers. Came in last week at 183.1, which puts us about 1% above trend, giving these favorable crop conditions. And again, we're going to look at some challenges on the demand side, on the consumption categories, and making a big crop like that obviously is going to put some downward pressure on prices. That just kind of puts in perspective what that corn yield looks like. To see that thing hit 180 bushels plus in 2024. That's a chart going back to 1980. And then that blue dotted line would just be a straight trend line projection. And that's going to be the foundation of our yield projection for 2025 here in just a little bit. And certainly with normal growing conditions, and that trend line that grows by about 2 bushels per year, if given just average growing conditions. So that's, again, that'll be the foundation here in just a moment as we look at our crop production prospects for 2025, and the early estimates are going to be for a yield again north of 180 bushels per acre. This will be updates to the balance sheet. I've got three columns here. Here's the 23 crop year, what we were thought in May, what this thing looked like, and then now where we stand in November, and how those things might have adjusted or changed for us. Again, the yield 183.1. We thought we were looking at 181. That was kind of the trend line guess back in May, and exceeding that to 177 bushels a year ago. However, the crop size, even with that record yield, is not a record production, not as big as the record we set in 2023 because we didn't have the acres. We planted almost 4 million acres less of corn in this country in 2024, but yet with larger carryover numbers, we don't have to produce as much corn, and we're still looking at very large supplies by the time we get to the end of the marketing year, and again, about a 2% growth in total supply. And we're just not keeping up with that on the demand side, with very little growth in the domestic categories. Exports, a little bit of a bump, but not enough to really propel us too much higher. Total use is about the same, 14.9 billion, 14.99 billion, just a little over a 0% increase. That raises our ending stocks, that raises our carryover, that days of use on hand goes from a 43-day supply. Not the 52 we were thinking this year, but still up to a 47-day carryover. And the average farm price, again, from a $455 a year ago, now down to about $410 for current expectations. And this is how this year's December corn futures have traded along what the index pattern would indicate for that contract. And aside from some significant deviations back in January, it's interesting to note how closely the corn pattern in the actual futures market in the black line this year has traded along that seasonal index, particularly if just in your imagination, take that red dotted line and shift it to the left about a month. So slide that whole thing over. And we have followed, very predictably what you would expect the corn market to do, how you'd expect that market to perform under these kind of normal growing conditions, this big crop on the horizon, and following certainly what typical seasonal patterns, except for the fact we hit the high about a month early, we hit the low about a month early, and now we're finishing with some late season strength about a month early. And that perhaps sets us on somewhat of a more of an upward trend heading early into 2025. And just looking at that relationship between that carryover to use, that days of use on hand at the end of the marketing year relative to the season average farm price. Here's where 2024 is coming in at that, mid 46, 47 day carryover. And you would expect a season average farm price in the upper threes, low $4 range. And that's kind of exactly where we're landing, about where we were in those large carryover years. Compare this current marketing environment to 2014, 15, 16, 17, 18, 19. Really tough years profitability-wise in our grain markets, and we're kind of in that range right now. And as we look at 2025 here in just a minute, the key question is going to be, do we shift that days of use on hand left or right? Are we going to push it higher into these lower price categories, or might there be some factors, some hope that would tighten those supplies a little bit and put us on a trajectory upward for prices? And so that'll be the key to our initial outlooks for 2025. Globally, a little different situation. Again, that stocks to use ratio in the U.S., that days of use on hand, we've been increasing that. But again, we're back up here now to that 47-day carryover. And again, look back to the last time we saw those areas. And when was that? 2014, 15, 16, 17, 18, 19. The difference, however, if you compare what was going on globally at that time compared to now the foreign or outside the U.S. Stocks to use situation, we had relatively large stocks in the U.S. and a relatively large carryover globally. Well, that global situation the last several years has been getting tighter. Now, globally, foreign situation, the world less the U.S., that situation is tighter now than it was back in those heavy carryover years that we saw in the U.S. back in that 14 to 2019 timeframe. So I think that does, and with that larger carryover in the U.S., we've kind of kept the world days of use on hand about steady. But I think that does indicate the importance of having that big carryover, that big crop in the U.S. to compensate with what is for a tighter stocks to use situation outside of the U.S. And so unless we have big crops in those foreign markets, or we have a continued big crops in the U.S. to maintain that carryover kind of where we've been globally, any significant shortfall, either one of those places, a major producer outside the U.S. or certainly here in the U.S. Could still create an opportunity for some volatility and higher prices. But at this point, the big crop in the U.S. has pretty well compensated for what is a tighter supply and demand situation in the foreign or outside the U.S. Corn producing areas. So a first shot at 2025. This column of numbers comes from the release from USDA last week of their long-term projections. And those projections, they go all the way out to 2034. And I don't get so hung up on what their corn yield and supply and demand numbers are going to be, 5 or 10 years from now. But I am very interested in what they think their stepping off point for their long-term projections might be. And that, of course, would be the 25 crop year. USDA is expecting 92 million acres of corn next year and a yield of 182. So not the record that we saw this year in corn yield, but perhaps we could have 1 million or 2 million acres more of corn planted. Again, with a relatively large beginning stocks number, production, not a record, but it does pushes up to record supplies because of that carryover number. And that becomes particularly burdensome for our markets moving forward. If you keep that beginning stock number around that 2 billion bushels, that's a lot of corn to start the marketing year. Domestic use, USDA's projecting us to a new record high. They're increasing feed use a little bit of increase in ethanol. Surprisingly, or maybe disappointingly, not seeing much growth in their export potential for corn in the new marketing year. And so without growth in exports, we're looking at total use that's very little changed from where we've been the last couple of years. But again, looking at that 1 or 2.5% increase in supply. And that's the same picture that we've seen in this last marketing year. And if that were to come about, we're looking at a carryover that's going from a 43-day carryover to a 47-day carryover. Now let's push that thing to the right to a 55-day carryover. And then the price response to that increase in stocks relative to use, they're pushing that USDA season average farm price down to $3.90 a bushel under that scenario. And again, back to our chart showing that relationship, moving that carryover out over those mid 50s. Again, that puts us kind of about where we were in 16, 17, 18, kind of out in that world of sub $4 season average farm prices for corn. That's pretty sobering. And so if we look at the futures market for December 25 corn, and looking at that thing trading this morning at about $4.43 a bushel, that's not a great price, given that break even in 2025 for most farmers in the U.S. is probably going to be closer to $4.70, maybe closer to $5. And so looking at a $4.50 on the board is not very encouraging, or $4.40, but it looks a lot better than $3.90 if we look at kind of where we might could end up this growing season. So I think it's certainly at least being aware of marketing opportunities, price floors, price protection. Even in prices, they're not great. But if we do look at the likelihood of the possibility of a relative bearish scenario unfolding, that could be some problems for us. So for 2025, really haven't changed it that much. We could see perhaps some slower growth rate in our expenses, in the cost of production, and maybe even a budget that's a little bit cheaper in 2025. But that's also balanced, which looks like a lower price outlook as well. My most optimistic expectations for a change in those demand categories would be from exports. But as Dr. Robinson mentioned, if we get into a tariff and trade war, that doesn't look very positive short term, at least in that kind of trade environment, because I think the importance of the global economy and global trade is recession out of the likelihood of possibility. It's lower, but probably not. But when we get down to disputes, disruptions, uncertainty around that global trade and global economy situation, I think could really be a tremendous factor for our price outlook for 2025, and of course weather affecting those major production areas. So that's what I'm about to share. Good to be with y'all here this morning, and I will do my best to close that presentation. And Dr. Anderson, I'm ready to turn it over to you.
Thank you, Mark. Any questions for Mark? Mark, I have one quick question. You mentioned, in 25, 26 exports, when you were looking at, you mentioned, more production, more basically because of more acreage. But you also, the USDA mentions, that exports are going to be lower in an environment where worldwide corn looks like it's going to be, worldwide stocks are going to be lower too. Why do you think is that?
Oh, okay. Could you restate that again? You broke up just a little bit, Pancho. Sorry about that. One more time.
Yes. So on on USDA projection for 25, 26.
Yes.
You have exports, U.S. exports are going to be lower than what they are now.
Yes.
With a lower price and basically more production. Now,
yes,
we also were talking that worldwide, worldwide stocks are going to be lower, or their trend is that they're going to be having less, lately these last years. So why do you think the USDA is expecting lower exports?
Yeah. I think be a couple of things. One would be the shifting of trade away from U.S. exports, primarily if you look at what's going on with China already. And again, these long-term projections, they're based on a set of macroeconomic projections, normal weather, normal trade policy. So those long-term projections would not include a trade war with China. That's not why USDA lowered that expectation. But I think what they're seeing, and the trend has been for the last several years, particularly when it comes to China, we're seeing a shift away from China's participation in the U.S. corn export market. They dropped way down during the trade war of 2018, came back in 2020. We were a major supplier of corn to China coming out of the kind of maybe a rebound from the trade conflict in 2018, 2019. But in the last couple of years, U.S. share of exports to China has dropped tremendously. Last year, 5% of U.S. corn exports went to China. 5%. In this current marketing year, exports to China are 0.1% of U.S. corn exports. 0.1% of our corn exports are going to China right now. And so what does that mean? That means China's buying from somebody else because they are the largest corn importer in the world. And so if they're buying from Brazil, they're buying from Argentina, they're buying from other countries, that may keep the stocks to use ratio, that days of use on hand globally, tighter because their supply and demand situation is more robust in that their use categories may be increasing relative to their production numbers, but we're not seeing that at this point in the U.S. So I think that could continue. So that U.S. situation continues to increase. We got heavier carryover numbers, but globally, with China participating in that market, that trend could well continue to be tighter because of that shift in trade flows.
Excellent.
If they make a crop in South America. Of course, if there's a production shortfall again, as we mentioned, just have a problem somewhere, and that trade picture will change very, very quickly because U.S. is still the largest exporter of corn in the world. Brazil's beaten us twice, but basically they'll come back to us. But in the current scenario, I think that's kind of where we're at.
Great. Hey, thank you, Mark. Appreciate it.
Yeah.
David, whenever you want.
Okay, I'm ready. You see my slide okay?
Yes.
All right. Well, I thought I'd call this one turkey time because we're almost there to Thanksgiving. So, heck, I want to start talking about turkey a little bit. Then we'll do a little lamb and a little beef stuff as well. So there we go. Heck, I want to show, I got really two turkey slides I want to show. One is prices, and we can consider these to be wholesale. These are hens, 8 to 16 pounds, so you're a little bit smaller bird as compared to your bigger toms. But gosh, you look at this thing, you can really see a collapse in prices that began basically April, May of 2023, and a really steady decline to really disastrously low levels. And we've been about the same level of price for the whole year, and even back to last year a little bit. And so if we think about the wholesale price in the spot market, prices have been really low. Of course, we got a lot of things going on in turkeys, some HPAI outbreaks. We got, things like that. We certainly have lower production costs with Mark's cheaper corn prices that he was talking about. So that's boosting some profitability a little bit. But, I think we really have some struggles on the demand side driving this. So, prices have been pretty low. In fact, I was looking around my grocery store this weekend. They got some turkeys out. Usually seems like about the 1st of November, the turkeys show up in the bins. So they got some turkeys out. I saw a special yesterday where if you bought a ham, you got a turkey. I think the turkey was for free. It was for one particular type and size. So there are some specials out there happening on the turkey side, really paired with ham, which is something that we tend to see a lot of. So we've got that going on in terms of these wholesale spot prices are pretty low. If we were to look at production, I've taken here the kind of ready to cook total turkey production monthly, and I've kind of made that a weekly average. And so to kind of show you the data a little bit better than the weekly stuff gets pretty close together. But what I want to show is that every month this year, we've been producing less turkey than we did last year. Really a response to low prices, some unprofitability. We're producing less turkey. In the weekly data that we would have for all of October, I don't have all of it yet monthly to put on this chart, but we do have production increasing, excuse me, as we normally do leading up to the holiday, but still we're producing less turkeys than we did last year. If we dug into the cold storage data, we would see a little bit more total turkey meat in cold storage in pounds. But that's not the case with the whole birds, which is really what we want at Thanksgiving anyway. So tighter supplies, but some good prices, at least low prices for consumers in terms of the wholesale side. But if we look at the grocery stores, we got some specials going on. So I think that gives us a little bit of insight into just thinking about the holidays and holiday demand and what's going on. I should say I have not bought a turkey yet. My wife is a real planner, and she said yesterday, we're late. I got to go get the turkey. So, I guess that'll be happening pretty soon. But anyway, those turkeys are out there. But I think it gives us a little insight into what's going on, maybe beyond what we normally have to worry about. Let me say something about lamb a little bit. I want to look at some 60 to 90 pound slaughter lambs. This is an average of San Angelo, Fort Collins, Sioux Falls. So you get a kind of a broad market average of these lightweight lambs. The blue line is this year. We certainly had a what I'd say is a larger than seasonal decline from our kind of Easter spring market down to the lows. We really had some low prices drop for a couple of weeks there. But we've seen a pretty strong rebound to some more seasonal, more normal maybe prices going on. I'm glad to see this rebound in prices. I think that's pretty important for producers. Those prices seem pretty dang low. And we would have seen the same thing in some more normal heavyweight lambs going to slaughter that have dropped. Those have also rebounded. But, for most of the year, we've struggled with more production than a year ago, more domestic production this year than last, and more imports as well. So that's part of the case going on. And which lets me jump into imports. Every month this year, we've imported more lamb from Australia and New Zealand than a year ago. I think it's pretty encouraging to see that big decline from kind of a larger than seasonal decline from August to September in the data. So that's some movement in the right direction. This trade data came out, I think came out on the 6th of November. So pretty recent stuff, which is kind of why I wanted to show it. But again, that's certainly positive. Is a little bit of movement in the right direction on lamb imports, but still it's more than a year ago. So we're still struggling with larger supplies than a year ago, both domestically and on the trade side as well. So I should mention too that if you saw there was a referendum in Colorado in Denver to ban meat packing, I guess in the city limits. And really the only outfit that affected was the old Denver lamb plant, which is a pretty significant packing plant in the lamb industry in the U.S. That referendum failed. And so my understanding is it failed, and by a wide margin. And so that's really pretty good news, I think, for the lamb market overall, that we haven't lost that packing capacity. So I think that's at least something positive on the side too. So some better prices. I think that's pretty encouraging. Let me hit kind of a hodgepodge of beef stuff that I think is important. On the beef cow culling side, we certainly normally see our strongest culling in the fall of the year. We are increasing seasonally. We look on the beef side. Gosh, I guess last week was our biggest week of slaughter since way back in the early in the year. Some seasonal increase, but it looks to me like the gap is widening compared to a year ago. And if you think about it, we certainly have fewer cows. So with fewer cows, there's fewer to cull. You would think we culled a lot of the easy marks a lot earlier. So maybe a little bit of evidence of some slowdown in culling, but still increasing seasonally. So that's a lot of cows. It doesn't change my basic view of the cow herd in the U.S. next year being smaller than this year. We don't have, there's still a lot of cows going to market. We need to see a much stronger decline to support a growing cow herd. and we continue to have not a lot of evidence for heifer retention. And I did not include the drought monitor map, but that thing looks pretty ominous to me. We got most of the country in some form of drought. And so, I think from a rebuilding herd standpoint, that's not helping things out either. Dressed weights, I think last month I was talking about, we had dressed weights pushing 950 pounds, an all-time record, and we've done nothing but shoot on up higher. So again, on the beef side, I mentioned the lamb market where we're producing more lamb than we did a year ago. On the beef side, on the fed beef side, we're producing more beef than we did a year ago as well, but it's driven by dressed weights. So if you want to take that 955 or 960 pound almost dressed weight for steers, divide that by 0.65, or excuse me, 0.635. That's a pretty decent yield to get from live to this dressed carcass weight. That'll tell you what the average live weight is, and those suckers are big. So we're keeping up with some beef production by pushing weights on the fed cattle side. Even though we're getting less beef on the cull cow side, we get more on the fed beef side. And those weights show up in beef production where, just look at the last couple of months. Every week, almost every week, we produced more beef than we did the same week the year before. So plenty of supplies going on, plenty of supplies. And I think that leads to some struggle in the beef cutout, the wholesale market, because we got plenty of supplies going on. I wanted to mention trade too, since we have that data. With our relatively high prices, and a market that works, what we're seeing is pressure on exports and more imports. And so if we net those out, imports minus exports, every month this year, the net number is bigger than a year ago. We're importing more than we're exporting. To put that in some context, look at that September number at about 150 million pounds. I'm going to round down. We got about 330 million people in the U.S. Let's round that down to 300 because it makes the math easy. So 150 million pounds net change in trade means about a half a pound per person in September, more beef on our market than, at least that's the sort of the net number. If we look at, that's another half a pound per person. If we compare to a year ago with about 75 million, that's about a quarter of a pound per person more beef on our market this year just from trade than a year ago. The 150, we compare that to a 5-year average, about a half a pound more beef because of the net trade than a year ago. I think that puts it in some kind of decent context for kind of what's going on the trade side. Just for completeness, I'll show a couple of price charts. We certainly have 500 to 600 pound steers. We see our seasonal kind of lows happening with some lower prices over the last few weeks. A little bit of increase, the last couple of weeks, but, seasonally lower prices, but at a level that's certainly pretty darn high. If we think about it most historically, go look at prices in our markets. They're still pretty darn good. And as I've said in plenty of kind of county programs and other programs, I do expect prices next year on average to be higher than this year, just simply with fewer cows, fewer calves, less production, continuing to support prices higher. We've seen a rebound in the fed cattle market. This is Southern Plains fed cattle. We've been back up to a $1.90 or $190 per hundredweight. We actually bottomed down at 180. So we put on about $10 per hundredweight in the last 6-8 weeks. Again, some increase happening that we would normally sort of see in the fall going on. Some better, a little bit of growth in prices. If we look at the wholesale market as measured by the cutout, we have seen about a $20 per hundredweight boost in the cutout in the last month. That's that wholesale market bouncing higher, really against this backdrop of more fed beef than a year ago and more choice beef than a year ago. So we got more supplies weighing on that market. And at the same time, we're kind of making that conversion from kind of summertime demand to fall demand when consumers are looking for different stuff. So we got that going on as well here, but a little bit better price in the cutout. Again, some of that's that's a real positive given the amount of supplies that we've got. And I'll show you one underlying cut from the cutout. If we look at wholesale ribeyes, you would notice that normally, if we look at that red line, we tend to hit a peak in ribeyes, the rib in the fall, really is a holiday kind of thing. We think about a prime rib, a standing rib roast, really competing with that, the holiday celebration, maybe competing some with that turkey, especially for Christmas. And so we tend to see higher prices in the wholesale market here, and we really see that in these ribeyes. These are boneless wholesale ribeyes. We've gone from about $10.50 per pound in the wholesale market to almost $13.50 in the last month. So really a pretty fast increased somewhat seasonal increase in ribeyes as we head for the holidays. So I think that's kind of interesting in the underlying meat market. So there's sort of a shotgun take a look at what's going on, and I will end my show. I'll stop sharing the screen and maybe. There we go. Anybody got any questions? Thank goodness.
No questions. Excellent, David. Perfect presentation. Hey, let me go and stop recording.